Hello everyone, Brian Glies with the Scott Insurance Agency. This video is on cash value life insurance and what you need to know. So there are life insurance policies that grow a cash value that can be used while you are living and still provide you a death benefit when you pass. So the details are important in any insurance product that we look at. The following slides are from my personal experience, and I encourage you to only take advice from your trusted advisor. Why would I want a policy that has cash value? The cash accumulated in the policy can be used during your living years. A real-life example of that is my wife and I purchased vehicles by borrowing money from the cash value of our life insurance policy and paid our life insurance policy back. To access my money in the life insurance policy, all I had to do was request it. There's no credit checks, there's no health assessment, there's no employment history needed, because whose money is it? It was my money. The loan that I take against my life insurance policy was also tax-free. You do want to be disciplined in the repayment of your loan. You decide on the payment terms. If I need to skip a payment for whatever reason, I can. Nobody's going to yell at me. But it is important. Don't steal from yourself. I look at the cash value in my policy as my bank that I can finance purchases for me on a tax-free basis. And my bank will not tell me no. So here's a side story. My great uncle played the role of grandfather in my life. Unfortunately, I didn't know my grandparents on the Glies side. When I was born, he purchased me a traditional whole life policy that grew a cash value. When I graduated from college, with his permission, I cashed out the policy's value and used it on a down payment for my first vehicle, which just so happened to be a Chevy S10 with a long bed. Now, if I'd known then what I know now, I would have taken a loan against that policy and paid my policy back. If I'd done that, I would have one heck of a policy in force still today. The thing was, no one was there to counsel me on my options. Since that policy was purchased when I was a baby, the low rate was locked in. If I still had it today at age 49, it would still be that low rate. The cash value and death benefit would have grown over the years to boot if I only would have known. So here's a little bit of a history lesson. We know that the government wants a piece of the pie. On the previous slide, I advised that the cash value that you borrow from your policy is done so on a tax-free basis. Well, in the 80s, the government looked at all of that tax sheltering, and they weren't very happy with it. With that in mind, they put in two pieces of legislation called TAMRA and DEFRA. If I paraphrase, the government capped the amount of money that you can accumulate on a tax-free basis in your life insurance policy. They put in force an equation that stated if you shelter too much money from us, we will tax you when you withdraw the money from your life insurance policy the same way as if you withdrew it from a 401k early. That didn't make a lot of people happy. The government calls that equation a modified endowment contract. If your life insurance company becomes a modified endowment contract or a MEC, it's a problem. So most insurance companies, why do I say most? Because you have to know who you're dealing with. They will take steps to prevent your life insurance policy from ever becoming a MEC or modified endowment contract. The fact that the government took steps to limit the amount of tax-free cash that can accumulate in your policy, it should tell you something, guys. So the difference, let's talk about the difference between tax deferral and tax-free. As young adults, we're always trained that tax deferral is a good thing. Deferral states that we're going to push the payment of taxes down the road. We have no idea what tax bracket you're going to be in 5, 10, or 20 years. From your general knowledge of taxes, guys, do they tend to go up or down? And I know in your head you're laughing and saying they never go down. From your general knowledge of income, if your game plan works out, will your game plan make your income go up or down? My hope is up. That's always the preferred game plan. So let's play here for a moment. If I told you you could borrow money from me, but don't worry about the interest, I'll charge interest. However, we'll figure that out sometime down the road. Would you make that deal? Would you make the deal of borrowing money not knowing what your interest rate would be? Well, that's kind of an example of what tax deferral does. So deferring taxes pushes the payment to a later date, and you have no idea what tax bracket you'll be in. I can tell you if my game plan works, I'll be in a higher tax bracket because I'm making more money. While my cash value in my life insurance is considered a conservative product, it grows tax-free, which will always be better than tax deferred. To access your money, access to your money is important. The cash value inside of your life insurance policy is yours. If you need it, all you do is make a request for it. There's no approval application to fill out. There's no credit check. There's no employment check. There's no age requirements. You can access your money when you need it. Previously, I referred to a cash value as my private bank. Like a bank, when I make a loan, there is an interest rate associated with the loan that the insurance company charges. The big difference is who are you paying the interest and payments back to? Yourself, guys. You got it. Yourself. This is what makes the process work. So important information about cash value policies. When you take a loan, an interest rate must be paid back to the policy set by the insurance company. If you were to pass away while there was a loan in place, the policy's death benefit would be paid less that loan amount. That's it. Depending on what kind of cash value life policy you own, borrowing against the cash value may impact the death benefit and monthly amount you pay for the policy. So that would be differences between variable universal life policies, or traditional whole life policies. The devil's in the details, and that's why you want to work with a trusted advisor. Ownership of the life insurance policy is an important consideration to avoid taxation of death benefits. Whether it's a different person that owns it, whether your trust owns it, it's a discussion that needs to be had. Ownership is also important if you're purchasing a policy for a minor. The cash value buildup only happens over time. It's not an overnight thing. And there's strategies you can use to shorten that amount of time it takes. So, quick note here on a minor. There are some policies that you can purchase for a minor that will revert to the minor as soon as they turn 21 years old. I don't like that, and I don't do that. I make the parent the sole owner of the policy until they feel that the child is responsible enough to take over the ownership of that policy. Because some kids, we referred to it a little bit earlier, will just cash that policy out. That was me, but I did get permission to do so first. But hypothetically speaking, let's say that your child was tangled up in something they shouldn't have been. Let's say that there was drugs in play or gambling was in play. We just don't want that to evaporate. So I want you to be the owner until you deem the child is able to handle that. So the most common types of policies that accumulate cash value: traditional whole life insurance, that's what I earn, universal life insurance, indexed universal life insurance, and VULs, variable life insurance policies. So when we take a closer look at traditional whole life is a very conservative product. The key feature is that the death benefit and cash value grow each year on the product. So it gets better every year you earn it. This growth is achieved by the insurance company sharing a dividend that it earns yearly on your money. This product has a built-in savings component. The product is not inexpensive, and many will tell you to buy a cheaper term insurance policy and invest the difference in the market. My experience is most will not have the discipline to do that. However, they will pay a bill. And if by paying the bill for whole life insurance has a side effect of a forced savings account, it solves the problem of not investing the difference. So within the illustration of a traditional whole life insurance policy, there's columns and values that the insurance company guarantees. I love that G word. And other columns that are simply projections. I like the fact that there's a guaranteed component of the contract. When I explain the contract, we focused on the guaranteed components. Then we look at the projections and say the projections will be the icing on the cake if they come true. Some companies will allow you to overfund a traditional whole life product. An example would be that you can make payments towards paid up additions to the policy. If we take a real life example, back in the day when I was much younger, I had proceeds from a 401k from a previous employer that I surrendered. I added that money, those proceeds, to the cash value of my life insurance policy. What that did was it increased the amount that I had access to, it increased the death benefit, and it helped, shall we say, supercharge that policy. This increased my cash value as well as the death benefit, as I stated. So now let's look at a universal life insurance policy. This product marries a term product, which is the cheapest type of insurance, and a whole life product to make a less expensive cash value policy. The universal life is designed to start with a $0 cash value and end with a $0 cash value. So the cash buildup inside of the policy is used by the insurance company to keep the premiums low. So the next box is the cash that's accumulated in the policy is utilized by the insurance company to keep the monthly premiums down. Exactly what I just said. Sorry about that repeat. I'm an insurance agent, not a marketing guy. The thing about a universal life policy is that if you take a loan from the cash value, while the cash value is there, it can impact the death benefit and how long the policy will last, how many years the policy will last before your payments start to increase. So there was a bubble of universal life policies where some agents were selling them at extremely low premiums that would not sustain the policy. And when the client was up in years, they would get a nasty bill. By that time, the insurance agent was long gone, and someone like me was called to pick up the pieces. The event could have been avoided if the policy was fully funded, meaning the insurance agent that sold it put enough premium in it towards the bill that the client paid to make sure that it would stay funded, which would have been up to that agent who sold the policy. While this policy does have cash value in it, it should not be used as a cash accumulation. That's just my opinion. Some people will tell you a universal life policy is a great situation or a great platform to do that, and I just don't really agree. But other people are allowed to have their opinion. So as we just stated, side story, early in my career, I had an individual call me about life insurance. He was an older gentleman, and I was new enough that I even brought my district manager along because I didn't want to screw it up. When we got to the house, the older gentleman was not in good health, and then every once in a while he'd take a moment to step out of the room to take a long drag off of a cigarette. So we explained to him that for several reasons we were not going to be able to help him with a new life insurance policy. Then he brought out the story. He advised that he had a life insurance policy, but he got a letter stating that he needed help understanding. The letter informed him that he owed a large premium payment to keep his policy in force. The agent who sold him the policy years ago did not fully fund the gentleman's policy for his lifetime. The agent would have, or at least should have known this from the policy illustrations. However, he sold the guy the policy that he could afford at that time and then went on his merry way to the next client, knowing he would be long gone by the time this policy folded. Please, please, please do business with a local agent that you'll be able to run into at your grocery store, at the movies, or at a restaurant. Keep business local whenever it's possible. It's one of the reasons why we're large in our community is because the people know where to find us if they need us. So next type, indexed universal life insurance policy. An index policy is one that allows you to capture gains up to a certain point while avoiding market crashes. So an indexed universal life policy is one that will allow you to play the market a little bit and capture some of those gains. The gains are generally based off the S&P 500. The attraction is faster growth of your cash value while not being quite as risky as a traditional variable universal life policy discussed on the last slide. It is still a universal life product and must be funded correctly. So VULs, Variable Universal Life Insurance. As you can see, the universal life policy has a frame that can be used in many ways. A VUL is a policy that is still built on a universal life policy platform, but it plays the game a little differently. It adds an investment component where the cash in the policy can be invested in a wide variety of separate accounts, like mutual funds, that you can pick and choose those accounts. The performance of the accounts can vary, just like any other investment, guys. There's more moving parts to this type of policy. However, the individual that wants to be a little more aggressive, this policy can be a good fit. The UL policy, Universal Life Policy, will still have to be set up to be fully funded to address the issues discussed in previous slides. So risk versus reward. Traditional whole life insurance is the most conservative approach to cash value life insurance and may be the most expensive. I like it because it has guarantees. We've discussed the Universal Life platform has several variations that can fit an individual's risk tolerance and want a faster cash value accumulation platform. Diversification is always a good idea. My portfolio includes cash value life insurance, and I believe the benefit of cash value life insurance is an area that does not get enough attention. When you hear someone say, "Oh, we've never lost a penny of our clients' money," I guarantee you a whole life platform is in there somewhere. So in closing, guys, hopefully you found this discussion to be interesting and thought-provoking. A qualified agent can design a policy that will benefit you while you're alive, as well as bless your family when you're gone. Life insurance is not focused on because so many other items get placed in front of it. Oh, by the time the end of the month gets here and it's the house bill and the auto insurance bill and the kid's school bill or whatever it is, there's always more month than there is money. But we want to have this conversation with you so we can start. Maybe it's not a cash value policy. Maybe it's a lower cost term policy. But let us help you, guide you through your options instead of you just curling up and saying, "Nope, not going to do it. Not going to do it. I'll do it later." So think about the benefits of gifting life insurance to young people in your life, whether that's a niece or a nephew. If your parents are still living, ask them to gift a whole life insurance policy to your kiddos, knowing that it can make a true difference in their living years. Thank you for your attention and time, guys. Let us know if we can ever be of service. Take a look at our Facebook page. Take a look at our YouTube page. We're here to help. It's as simple as that. Give us a call, 636-456-8633. Hope you have a great day. Thank you.